think that at the very, very least, the cycle could be changing. The incentive to rotate out of Bitcoin is far more reduced than it has been in previous cycles. If the institutions are creating this persistent bid, and then we have corporations creating this persistent bid, we now have a base. More money in the market means that people are going to go further and further and further out in the risk curve. Now, digital asset treasury companies, I'm completely bearish on. This could be being a toxic Bitcoiner, but I'm just going to say it anyway.
Quick reminder, nothing said on Supply Shock is a recommendation to buy or sell any investment or product. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. Hey everybody, welcome to Supply Shock. Pete Rizzo, the Bitcoin historian on X, here with another great episode. We're going to be digging into the current debate. Is the Bitcoin 4-year cycle dead? Will it be revived? Are we coming towards a blow-off top? We've heard a couple different voices over the last week give different opinions. Matt Hogan of Bitwise boldly declaring that this time is different. We had Michael Turpin, author of Bitcoin Supercycle, taking the counterpoint now. We've got Adrian Morris of True North, the collective, influential collective on Twitter, on X, that is constantly in the conversation about Bitcoin treasury companies and the Bitcoin adoption by corporates. Adrian, welcome to the podcast.
Thanks for having me. I'm excited to be here. This is the first time you and I have had a chance to interact, so I think this could be a good conversation.
Yeah, I'm looking forward to it as well, and I always appreciate guests bringing, perspective that aligns with the current zeitgeist. So we've got this terse debate about the 4-year Bitcoin cycle. I'm on the record writing for Forbes in 2021 about Bitcoin cycles. At that point, I was, pushing in the mainstream this idea that the Bitcoin cycle will repeat, that Bitcoin should be seen as cyclical because the nature of the supply of Bitcoin is what gives it the economic power, right? That's what differentiates it from other competing cryptocurrencies. It has this economic programming, if you will, that makes the asset more valuable over time. Maybe at a high level, your take, the 4-year cycle, is it over?
I would say that, so before I go as far to say that it's completely over, I'll just give my thoughts on it as to why I think that at the very, very least, the cycle could be changing. One of the things that I've thought is that people correlate the cyclical nature of Bitcoin with the halving cycles, and some also can correlate it with the halving cycles and liquidity. I think that part of the equation could be that in previous cycles, Bitcoin has also been the beneficiary of a lot of stimulus. So we had a lot of government stimulus, we had a lot of printing of money in the amount of trillions and trillions of dollars. And I think that the boom bust cycles that we saw could be more correlated to the fact that we had a lot of stimulus coming into the market at these different times in the cycles that just so happened to have lined up with the different cycles. And because one of the things that I say is, liquidity seeks quality while stimulus seeks speculation. So I think that the boom bust that we saw was more related to the cheap money that was in the system and the fact that people were seeking new assets and they were going further and further out on the risk curve to speculate with that money. And that led to the run-ups and the crashes and the run-ups and the crashes and the run-ups and the crashes. While this time, I think that with the institutional players, we may see one, a decrease in volatility, which I think is being, it's playing out in the sense that when the ETFs launched with Bitcoin to now, the volatility has dropped. And I think that decrease in volatility would lead to more, I don't want to say pure stability or anything like that, but the decreased volatility would make it more attractive to a broader cadre of potential investors. And just by a function of looking at things that have happened with like the gold ETF and just looking at the way the inflows have been happening currently with like BlackRock and Fidelity, and then we have corporate adoption, the impetus to rotate out of Bitcoin may be significantly reduced and because the boom bust cycle may be less likely to happen. So in the past, you have people going from Bitcoin to altcoins, capital leaves the market. But right now, you have institutions that are accumulating Bitcoin on behalf of their clients. You have corporations that are accumulating Bitcoin on the balance sheets because they've seen how successful it can be. In the case of strategy, and I think what we're seeing with strategy is that their success from last cycle to now has, quite frankly, influenced a lot of other corporations to try to take on a similar strategy and add Bitcoin to their balance sheet. And because of that, the incentive to rotate out of Bitcoin is far more reduced than it has been in previous cycles. And that's kind of just like the 1,000-foot view of what I'm thinking.
Yeah, I have a couple qualms with this. I wouldn't say like overall troubles, right? Like I think I get the idea that the overall liquidity in the global macro market influences Bitcoin. This was, of course, in 2021 a big kind of dominating theme of the cycle as Bitcoin is macro. It was almost a meme at some point. But I noticed in your piece, you had some thoughts on the earliest stages of Bitcoin. So I thought we'd start there. If you roll it back to 2011, 2010, 2013, obviously the Bitcoin market was so small, right? And I think it's a question of really when was Bitcoin big enough to be impacted by macro. That's kind of, that I feel like is more of the question, because when you go back to 2011, 2012, when somebody posting on a Slashdot forum costs a 50% increase in the price of Bitcoin from 5 cents to 10 cents. Obviously there's no macro liquidity moment impacting that, right? Like that's somebody posts on a forum, and Bitcoin was that small. I get that there's some point of no return, right? There was some kind of point on that line, but it sounds like you think really as far back as 2013 you could make the argument that global liquidity was influencing Bitcoin's price.
Yeah, because with regards to my overall thesis with stimulus and stimulus seeking speculation, more and more money in the market means that people are going to go further and further and further out in the risk curve. And we can debate whether the earlier years of Bitcoin were driven by guys like us, being in the market because it was so small and driving the price up and having a disproportionate impact. Or we can also debate that the very presence of stimulus from QE1, QE2, QE3 made it more likely for people to seek out those opportunities. But I think that the necessary, I don't want to say first cause, but perhaps, is obviously money. I'm sure we'll agree on that. People buying Bitcoin, supply and demand. I think we can agree on that. So, with that said, what environment is more likely to cause people to even be receptive to something like Bitcoin, even in a small amount? I would say that a broader macroeconomic environment, if we consider what Bitcoin, the ethos of Bitcoin as a response essentially to the great financial crisis, and what was going on in the broader market in terms of stimulus injection, and what was going on in the market in terms of overall sentiment. The world had just been kind of jilted by the GFC, and it's very, very likely that all those three things played into that first. I don't know if we can call it a cycle, but I call it a cycle just because I'm trying to put things into years and buckets. But that first, from the genesis of Bitcoin to like 2012, 2013, when I started getting into it, I think an argument to be made that even though globally Bitcoin wasn't a factor, the fact that there was so much stimulus in the environment at that time made it very likely for Bitcoin to even catch a very, very small bid. And that could be part of it.
I think Chamath Palihapitiya has a really great quote on this. I don't know if you caught this, but maybe fits into the frame here, which he was on. I believe it was the Tucker Carlson podcast. This was part of Silicon Valley's embrace of sort of the right prior to the last election, where he basically said everybody in Silicon Valley, their attitude from in the early 2010s was they thought they were all geniuses, right? They had this idea that they had some sort of magical ability to create and fund companies that were gaining huge valuations. You think about the social media, the Web 2.0 environment. And he said on Tucker's podcast that, what he found out is that it was all the easy money, is that was what was powering into Silicon Valley. That's what was creating sort of his ability to make value. And it seems like that's actually colored his insights. So it sounds like that would lend credence to your argument that essentially these easy money environments, and then maybe 2017 would be the best candidate for that, where the money that Silicon Valley had to deploy into Bitcoin and alternative cryptocurrencies during that bubble, was probably derived from the actual initial kind of stimulus of the ZERP era at that time.
I think that could be possible. And the reason why I've kind of coalesced around this thesis at this point is because I go back to how I was brought into Bitcoin. I'll just give you kind of like a little overview of that. The individual, and I don't want to dox him, so that's why I'm not saying who he is, but the individual that brought me into Bitcoin, I knew him from college, from grad school, right? And I just been seeing him one day walking in St. Paul, and he was moving into a house, and he was moving in a bunch of gear, he was moving in a bunch of stuff, and I had no idea what was going on. He is the individual that brought me into Bitcoin from understanding mining, He brought me into Bitcoin with monetary theory, and he actually got me thinking, even back then, with his explanation, talking about stimulus, talking about stimulus injection, talking about broader macroeconomic trends. He's the guy that orange pilled me. But his orange pill moment for me in that conversation was monetary theory. It wasn't, mining or understanding even the white paper. What got me into it was thinking about monetary theory. And the reason why I'm carrying that forward is in the example you just gave with like the ICO bubble. Let's talk about that in like the 2016, 2017, and the bubble that was going on around Bitcoin. And it's run up from what was it, sub 1,000 to 19, whatever it was.
Yeah, I went from about 1,000, which is the previous all-time high. I think it was 1,200 was the previous all-time high, all the way up to 19,700.
Right below 20, right below 20,000. And then CME Futures launched and killed that run.
Break
Because
it down.
I remember that one. So, and the reason why I'm bringing this up is back to my point of liquidity seeks quality while stimulus seeks speculation. I remember, and this is the phrase that I use. I can close my eyes and throw a dart at a particular altcoin back then and make money. That coming back to the easy money analogy, that and the analogy I use and something I just wrote recently was hot money. That hot money, easy money analogy, I think fits because it was a frenzy cycle. And there was two aspects to it. And I don't know whether you agree with this or not, but and this could me being a toxic Bitcoiner, but I'm just going to say it anyway. A lot of the run-ups in altcoins happen because people assume a local top in Bitcoin, then they rotate in their altcoins. And because altcoins have smaller market caps, they can push the price up very, very quickly, right? And a lot of times, guys started altcoins to raise money to buy Bitcoin. They were essentially pump and dump scams that allowed them to raise as much fiat as possible and rotate back into Bitcoin and then leave the market. So that all of those dynamics feed into that easy money, hot money kind of dichotomy because where else would the impetus come for people to be going further and further on the risk curve?
Well, I think my one caveat to that is at that time, and I would argue there was probably already always going to be a period where this was the case, where there was a big investment in 2017 into terms of finding out if someone could make a better Bitcoin. And so my argument has been, even if you think that that was a fruitless endeavor, and I agree that I think that the end result of that has been pretty fruitless. I think you were probably always going to see a period where that happened, right? It's with a new technology like Bitcoin that was just so groundbreaking and so new. There was a lot of hubris in the technical community as well, where the developers really thought they could recreate Bitcoin. Obviously, we know now that they have not, and that they have failed to do that for 10 plus years. But I think you would have probably already seen one of those periods, and a little bit of fairness to the folks at the time there, because I do think there were some people who legitimately thought that that was a possibility. I think that would have always happened. I think it's hard for me to say like, the Wright brothers built a plane and then, nobody built a better plane, right? There was kind of a period of experimentation. Ultimately, people coalesced on their design. But I agree with you on premise, right? There was a lot of froth. A lot of it was driven by liquidity. What are your thoughts on 2021 though? Because it does seem that, we heard a lot in 2021 about, how inflation was going to push people into Bitcoin. That was sort of a big narrative of the time. Obviously, the stimulus did go into altcoins again, right? We had the DeFi summer and NFT mania, some of that going to Bitcoin at the top. And then second half of the cycle, Bitcoin maybe took a little bit of the back seat. And, we were kind of hoping at the end of 2021 that would see another breakout. It sounds like you think it was just the lack of liquidity that even though maybe cyclically and programmatically, there should have been a peak in 2021, the lack of liquidity was what made that impossible. Why that didn't happen.
For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com.
As always, investments in blockchain technology involve risk. Terms and conditions may apply. Do your own research.
Well, I like to draw a distinction, a sharp distinction, I could rightly or wrongly, between stimulus and liquidity. Liquidity, in my mind, comes from decreased interest rates that allow cheaper borrowing capital that gets into markets. Stimulus is direct government intervention, pumping money into markets. So I would say the lack of stimulus, or rather the presence of stimulus, exacerbated the frenzy more so than anything having to do with a direct correlation with liquidity. And the reason why I say that is coming back to liquidity seeks quality while stimulus seeks speculation. Let's take a look at what happened in 2021. We had what I like to, or rather more like into 2021 into 2022. 2021, and I don't know if you agree with this, many people think that Bitcoin should have run up to 100K. But the reason why it didn't is because we had people playing rehypothecation games, right? We had BlockFi, we had FTX, Alameda, we had Celsius, probably Binance, though people like to deny it, playing all kinds of games to suppress the price of Bitcoin. That kind of environment, in my view, creates a perfect storm where you have bad actors in the space, you have frothy stimulus coming in. I mean, I knew guys that were throwing their COVID stimulus checks into altcoins that made absolutely no sense, and they were doing that because they had the free capital, they had the free stimulus, right? Now, they probably would have acted somewhat differently if they had been working, saving money, and then chose to invest. So that's why I say that stimulus seeks speculation. And I think those environments create a broader macroeconomic reality where you have a lot of stimulus coming in. We had the COVID stimulus. We had what was it, the CARES Act and the American. I always forget the second one, but we had two acts that pumped in massive amounts of stimulus in the form of trillions and trillions of dollars. You had people getting stimulus checks. You had all sorts of captive environment dynamics where we had the lockdowns in 2020. So people probably were feeling extra frenzied now that things seem to be kind of taking a turn. Bitcoin had that run up from, that COVID crash all the way up to over 60,000. Yet Elon Musk tweeting about it. We went from 40,000 to 60,000 because of him alone. That just seems to me like a highly stimulative, speculative environment that's not necessarily being driven by liquidity purely. And if we could create a correlation between the two, like let's look at today. People are constantly saying that AI is a bubble. You have the Mag 7 that's running hot, right? That to me is a quality seeking endeavor. And also with Bitcoin, the dynamics today are a quality seeking endeavor because you can tell by the kind of players that are in the market that are driving the price up. I think retail is being largely represented, and we can probably get to this, by the treasury companies, while Bitcoin itself is being pushed by institutions, and the Mag 7 is being pushed by institutions and retail together. Entirely different.
I think that, where I'm assuming you're leading up to is that, this year, the difference that we're going to see from past cycles is that we're about to see a lowering of interest rates and the Federal Reserve come and make borrowing less expensive. So I'm assuming this is sort of the groundwork for your thesis of why you think maybe next year will be a bull market and maybe this quote cycle will be elongated.
I think that, so yeah, let's use a cycle example, right? Because I'm still of two minds whether I should call it a cycle or not. But let's say that it is, right? And let's say that it gets elongated. In my thesis, the reason why I think that is because we've already seen Bitcoin run up with higher interest rates. We've already seen Bitcoin run up over 100,000, right? We've had a environment where liquidity has been largely on the sidelines and slowly coming back into the market. And we also have dynamics where we've had trade Armageddon, the tariff Armageddon earlier this year. We had the yen carry trade unwind last year. We've had tensions in the Middle East have reached a fever pitch. We've had an ongoing situation with Russia and Ukraine. We have all these different macroeconomic and geopolitical events that in previous cycles, as I'm sure you remember, would make Bitcoin crash. We would have dropped by 30, 40, 50% on any of these alone. That has not happened. And to me, just very broadly, that is saying we have a different investor base in Bitcoin proper. So in spot Bitcoin, we have a different investor base that's driving the price up. We have guys like you and me that are not selling. We have retail on some level, yes, but I think what's been pushing up the bid is institutions and corporations. So what that says to me is when interest rates do start to come down, so if Powell cuts in September and we get half a basis point, and we get half a basis point, right? I think what we could see before that point is if the market's sniffing that out, which I think they are, things can start to run up into September. We get that first initial rate cut, then we may get another rate cut in October, and the price can still run up because that will encourage more people to come into the market. And coming to the elongation thesis, if we've already been running up in an environment that's created all the impetus possible for people to rotate out of Bitcoin, and that massive rotation has not happened, it's only accelerated, then even with broader macroeconomic challenges in a lower interest rate environment, we can see Bitcoin still run up. And that's where I come to my stairways to heaven scenario. I don't know if we see the 3, 4, 5, 6x like that as we have in previous cycles, but I do think it's possible that we can go from 100 to 150, consolidate, 150 to 2, consolidate, and just take the way up along those lines in a further, I guess you can say, elongation of the cycle, or you can view that as an invalidation of the cycle. It really just depends on where you fall on it.
Well, obviously, Michael Turpin was on. He kind of laid out his thesis for why you'll see a strong cyclicality. So the stairway to heaven to a million Bitcoin idea. One of the big data points that he referenced, and this strikes strongly to my lived experience, which is that old G's have a lot of Bitcoin, right? So people who are whales in the space from the prehistoric 2010, 2011, 2012 era. We recently saw the Galaxy whale, right, sending 80,000 Bitcoin to market, selling it. So all this is to say is that there's still a lot of capital in the old hodlers. And the behavior of the old hodlers, essentially, as Michael put it, is that, they are waiting for these tops. They sell these tops and then they live off the capital, right? And I know a number of kind of old miners, old Bitcoin developers who engage in this process, right? They wait to sort of, the market gets frothy, they sell some coins. They use that to kind of, live what's now, a life of leisure, right? So they're a seller base, right? They become sellers over time. And so a question I have with the 80,000, Bitcoin whale, though, is that going to continue, right? Do we see that behavior continue, and is it enough to offset, the interest in from institutions simply because the numbers are heavily skewed, right? There are individuals out there who own 100,000 Bitcoin, right? We know that there are single individuals holding that much, right? And I'm curious your thoughts on how that might offset liquidity, because it's just a different investor pool with different habits.
Right. So, and let's take a few steps back. I'm sure you remember F2 Pool and what they were doing last cycle. They were dumping 15, 20, 30,000 Bitcoin at a time at very advantageous times. We would reach a point where we're supposed to hit a breakout, then all of a sudden magically they'll sell and the price will just tank, right? So that lends credence to this potential thesis that we have OGs out there that can be selling in massive amounts at tops and living off those earnings, and exerting sell pressure to push the price down. The counterpoint to that is someone just sold 80,000 Bitcoin and we dropped $5,000. That's it, right? We didn't drop 20%, we didn't drop 25%, we dropped $5,000, or maybe I think it was like 6. I can't remember the exact number. Point is that did not have a disproportionate impact on the price. And we have been ranging since then, and I think we were just at 116, 117 at some point today. So I'm bringing that up to say that the larger Bitcoin's market cap gets, the more extreme the sell pressure is going to have to get to cause those dips. And and let's just use this range. If between 110 and 120, someone can dump 80,000 Bitcoin and only drops us down by less than $10,000, how much do you think it's going to take to do that at 200, then at 250, then at 5? Do you see what I'm saying? Everything becomes harder to move in terms of both going up and going down, the larger Bitcoin's market cap gets. And if the general thesis is correct, that the institutional base is forming the base and it's creating an entirely different investor profile for the Bitcoin ecosystem, where in the past you had people that would rotate into something like Fartcoin or Pepe or Dog with Hat, while now someone holding the ETF, someone like my father, for instance, it was hard enough to get him to buy the ETF in the first place, let alone for him to sell it and rotate into altcoins. It creates an entirely different thesis for what the market can do. So if the institutions are creating this persistent bid, and then we have corporations creating this persistent bid, we now have a base. And where the froth may come in is if there's a retail mania, sure, that can still happen, where we see run-ups. But my whole thing is the larger the market cap gets, the harder it is going to be to move it up, and the harder it's going to be to move it down. And that's why I say the stairs to heaven. We're going to reach different levels and just keep stair-stepping our way up. And the reduction in volatility plays into that as well. That comes as part of this process. So that's kind of the way I think about it. OGs are going to sell, and I've heard the similar conversations as well. But there's other OGs that are seeding these Bitcoin treasury companies as well. So there's there's nuance there. It's not as just if OGs are just going to be selling matter of factly, fait accompli, whenever Bitcoin hits a certain price and living off their gains. There's other OGs that want to see this extend, that want to see this grow. So I think it can play out, and that equilibrium is where we're going to find where the price lies.
For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com.
As always, investments in blockchain technology involve risk. Terms and conditions may apply. Do your own research. Right. I think it speaks to the conviction amongst these different hodler bases. So I think breaking down your thesis, and this is where I'd like to maybe pick it apart a little bit, is that it sounds like you're saying that there's conviction amongst institutions and corporations as two different classes. I think I would agree with you that there's conviction on the corporate level. These are companies being specifically designed to accumulate Bitcoin. There's a culture around that accumulation, and then there's a strong willingness of that community. They see the prize, right? And being a company that owns a large amount of Bitcoin, they see the ability to turn that into a long-term business, to maybe even become one of the largest, companies in their local geography. So a lot of conviction there. So the question that I would have then is really, how much conviction do you think the institutions have? Because, we've seen them kind of come in and out of the market before, a little bit in 2021, right? There was this kind of institutions kind of came in, they came out. And when there's money to be made on volatility, I wonder if the institutions will come out again, right? So to the 80,000 Bitcoin whale, maybe it was timing, right? Maybe it's just in the middle of the cycle. We're not close to the end of the year. A lot of these, really big dips in Bitcoin have come, towards the end of the year or after the year. My theory on that is essentially it's a taxable event, right? These are traders who want to trade their gains and roll it into something else. So I guess the question where I have is like, what do you think the conviction level of institutions is in staying in the Bitcoin position when, if they think that there's a 4-year cycle, they think the pattern will repeat, they can rotate that capital out and put it somewhere more that's more efficient, and then do the same thing with Bitcoin again. It's just I guess I don't see the data points that they're going to be very convicted, right? I don't really necessarily buy that like BlackRock is very convicted, right? I think they want to sell the products. They're a convicted seller, but I'm not sure they're a convicted buyer.
Let's roll it back again. I think the institutional players we had in other cycles were playing that stimulus seeking speculation angle, which is why the rotation was happening. And because I don't believe that the institutional players we had in the past were seeking anything about, and we can probably fully agree on this, they were not interested probably in Bitcoin adoption. They were not interested in the Bitcoin ethos. They were not interested in any of that. They were interested in making money. And that comes back to the stimulus seeking speculation aspect of it. This cycle, it is not a matter of BlackRock or the institutions like Fidelity being convicted. It's a matter of them being greedy. They have a vested interest in Bitcoin's price rising, because the higher the price, the more they see in fees. So there's that one reflexive feedback loop. Another feedback loop that can happen is that when you have Uncle Larry, as I call him, Larry Fink, going from Bitcoin's index for money launderers to its digital gold, that to me, someone like him saying that does reveal a level of conviction. Whether the conviction is and he's a Bitcoiner, I don't think that's what it is. A level of conviction in seeing that, oh, this is a macro trade that I can ride for the next 20 years. I think that's the kind of conviction that institutions will bring to bear. Now, that trickle down effect is probably going to be seen in the investor base because how do you think they're communicating these products to their investors? They're not saying that, oh, you can ride this for a year and then get out. So what they're saying is you can allocate a portion of your portfolio to this asset, hold it for 5, 10, 15, 20 years and see disproportionate returns, whether they use the simple analogy of you can turn a 2x into a 5x, or you can have a 20 to 30% CAGR. That it all depends on how it's going to be communicated. I think that creates a feedback loop in the dynamic. So, regardless of their motivation, they are motivated to see Bitcoin succeed. That, I think, is what's gonna feed it, and that's what's gonna feed the staying power of the institutions, because they've already seen since the launch to now what has happened in a relatively restrictive environment. What do you think is gonna happen when the reins come off, interest rates come down, you have more players in the market, the asset stabilizes, you get more adoption, et cetera, et cetera, et cetera. I'm sure they've done all these projections. So it is not a matter of the institutions changing their stripes. It's a matter of their goals and our goals in terms of Bitcoin becoming the biggest thing are now aligned.
Well, a counterpoint to that, maybe that I would add is that I think we maybe have just recently seen, or an example of just how fickle the institutions are, right, in regards to Bitcoin and crypto. We've seen a huge swing in sentiment with Ethereum specifically, CNBC, really kind of leaning into this coverage simply because, the altcoin communities have now adopted the Bitcoin Treasury strategy. So maybe we can kind of talk about corporates here and, segue with this institutional bridge, which is that Larry Finks and the Wall Street crowd, they seem now just as happy to, push Ethereum, at least what we've seen from the last couple of weeks in terms of how aggressive, the sentiment shift has been. So, obviously, I think they're aligned on Bitcoin and selling the products, but, if they don't have that conviction, if they're also pushing competing products, that's why I just wonder is that it's like, I say convicted sellers, right? They're convicted that they know this is a product they want to sell, they have asset class that they want to sell, but I don't think they hold the same conviction that like we have as Bitcoiners, like or that the Bitcoin treasury companies have, where these are clearly like corporate entities being operated by people with a long-term Bitcoin vision. I think my only point was just denoting that these institutions clearly don't have that. There may be some alignment and like they want the Bitcoin product to be successful, but they also want their Ethereum product to be successful.
Oh, absolutely. But and see that's the difference why I made a distinction in saying that the interests are aligned. Having aligned interests doesn't mean that's the only interest they'll have. So I don't think that the push for the Ethereum ETFs was because they want to say it's going to be more successful than Bitcoin. They're institutions and they see it as another change in the guard in terms of asset class, in terms of technology, in terms of potential adoption where they can make money. I'm not trying to paint the institutions as benevolent actors by any means. I'm trying to paint them as they are interested parties that have interests that now somewhat align with the Bitcoiners in the sense that we want to see Bitcoin go up. We want to see Bitcoin adoption. We want to see Bitcoin growing. So do they, because they make money off of it. Now, that is not the Bitcoiner ethos per se, but those are aligned interests on some level. Now, coming to Ethereum, I don't, and back to what I was saying, I don't think that necessarily says that they're fickle. I think that says that they're opportunistic. They know that Bitcoin's success, the launch of the Bitcoin ETFs and its success, would likely lead to the Ethereum success. And I think what we're seeing right now in terms of what you're talking about with sentiment, and we can come back to this later because I believe that markets move on sentiment. The recent legislation that has come through from the Trump administration with regards to the impact they can have on stable coins, the Genius Act, so on and so forth, I think that's having a feedback loop into the bid that we saw coming up on Ethereum. And as usual, the institutions front ran it. They always know what's going to happen before the market does, or before the retail investor does, before the street does. So that's why we saw Ethereum go from like 17, 1800, whatever it was, all the way now to teetering on 4,000. It is the fact that the money, the capital front ran that event, and now retail is getting wise to it. Well, there are some guys on Twitter that are wise to it, but by and large, now retail can get wise to it. So I don't think that's fickleness. I think that's opportunistic. Now, the counterpoint to that is, well, could they opportunistically rotate out of Bitcoin? Sure, but let's talk about things in terms of what's possible versus what's probable. Is that possible? Yes, anything is possible. Is that probable? I'm inclined to say no, because of the very reasons that I just gave. They have a vested interest in Bitcoin's success, and they're not gonna rob Peter to pay for Paul in the sense of going from Bitcoin to Ethereum. They want Peter and they want Paul. And that's what they're gunning for right now. And that's what the legislation has opened the door for in terms of the stable coins, I think. This is not me being an Ethereum bull by any means. This is just me saying that this could lead to Ethereum catching a bid. And they seek to benefit from Bitcoin for all the reasons that we've just discussed, for Ethereum for the reasons we've just discussed, but also why haven't they pushed as hard for a Cardano ETF or a Solana ETF or
Oh,
an
I think that's coming. That's
it
coming.
might be, but what I'm saying is, here's what I would say. Do you think Larry Fink, the man that is in control of the largest fund in the world with the most assets under management, over $10 trillion, would not have an XRP ETF or a Cardano ETF or Solana ETF right now if he wanted it?
Well, I mean, I think they have to go through market sentiment and consensus, right? And the consensus on Wall Street is still that they see these assets as experimental. But I do think that it's just remarkable how much the sentiment shifted on Ethereum from this was a product that really had seen no bid for about a year into just very strong positivity in a short period of time. And I think would be remiss not to think that that can happen again, as you're saying, opportunistically as it extends to the larger asset class. But I think my point was, it seems like your thesis for we're talking about the stairway to heaven to a million here. This idea that changing sentiment in the market will eliminate the big downs, the 4-year cycle. And it sounds like you're saying this is you see confidence from institutions and the corporates. And so I picked a little bit about the institutions, why I think maybe they're not as aligned with us. The corporations, I think I want to dig in with you. Obviously, the True North crowd pioneering here, but the corporations have acquired all this Bitcoin and they have this conviction, but they have debt, right? They have different instruments that use to acquire this Bitcoin, and they may acquire Bitcoin in the future under conditions that maybe prove later to be not opportune. So I'm curious, like how much you think, because I think that group has a lot of conviction, but they also have a lot of risk. They have a at least the current market participants. So I'm curious your view on that.
Well, the most obvious example we can use to discuss that is strategy, right? So let's discuss kind of what they've done. They're disproportionately, the Bitcoin they've bought has been through equity, not through debt. So they issue equity at the market. There's a variety of ways you can explain this. Some people call it farming premium. Some people call it taking advantage of the multiple. Some people call it waiting for MNAV to hit a certain level. We can use whatever analogy you want. But essentially, their share price is trading at a multiple to their underlying Bitcoin. That multiple is where they live to issue shares to the market, sell it to the market, raise equity, and buy Bitcoin. So in terms of the risk from debt, there's no risk there. Coming to the debt, the convertible notes. One, they're not over leveraged. In the case of strategy, their leverage ratio is below 16%. Two, the debt is unencumbered. So it's not as if there's going to be a margin call on Bitcoin that's going to force them to sell. And three, they're paying back those convertible notes with equity at a later date. So they have notes that go up to 2029, 2031, and 2032, I believe, or one of them is in 2030. I got to double check that. But long story short, even those convertible notes, when they come due, they're going to be paid back with equity. And there's opportunities for them to exercise that at an earlier date as well. And I say all of this to give a very, very general overview of the fact that the purchasing of the Bitcoin, let's use a nightmare scenario where we see an 80% drawdown again, right? Are they going to be forced to sell because of their debt? Not necessarily. Corporations have all sorts of ways to stave off disaster that individuals do not. They can issue more debt to the market, and even at times where it's not necessarily advantageous. And what's going to take the brunt of that impact is going to be the equity itself, not Bitcoin. So the corporations, if they are in an environment where Bitcoin is drawing down, they are more likely to stand pat and see what the market is going to do. They're not likely to issue shares to the market because they probably will not be seeing a premium at that time to justify it. They are not likely to start saying, okay, we're going to dump our Bitcoin. Even if the drawdown happens, the drawdown is going to be reflected in the equity. That Bitcoin on the balance sheet is still going to have value. And some can say, well, the first thing a corporation is going to do is if they face that event and they're going to start selling Bitcoin to make the ends meet. Okay, so let's go with that example. The nature of business is that you're going to have some that are over leveraged and some that are appropriately leveraged and some that are just doing whatever the hell they wanted to do and had no idea what they were doing. That's the law of averages. What effect would that have on the market? If Semler Scientific goes down, they sell, let's say they double their Bitcoin holdings. They sell 10,000 Bitcoin. Okay, we just saw 80,000 get sold. Metaplanet, they sell 20,000 Bitcoin. Okay, we just saw 80,000 get sold. Do you see what I'm saying?
That's a strong counterpoint. And I guess especially if you look at the mix of coins too, of the 90,000 that are owned by these companies, it's really only 300,000 that's outside of MicroStrategy at this, or strategy at this point.
Yes, but the liquidation event is not as if it's going to happen on a Tuesday and they're selling Bitcoin by a Friday. There's going to be a series of events that happen before we even get to that point. And I think while there is a tail risk of one or two or maybe even more of these companies failing, what I'm proposing is corporations are far better equipped to weather that storm because of how corporations are structured versus individuals that are dumping Bitcoin or mining pools that are dumping Bitcoin or Bitcoin miners that are dumping Bitcoin. It is a different dynamic and a different kind of selling pressure that will exist.
I did want to touch on it because obviously this is a podcast on Blockworks. Blockworks is a more crypto-facing media platform. We got a lot of folks out there who listen to the podcast and want to learn about Bitcoin, but maybe coming from that broad perspective. There's been an appropriation of this digital asset treasury movement, or the Bitcoin treasury movement, into the digital asset treasury movement. We saw Tron come to market. Probably going to see a lot more. I think BNB coming to market with a specific coin vehicle, XRP, and all these things. Obviously, you've been in the trenches with True North. Sure, you're very skeptical that these businesses will accrue long-term value, as I am. But what do you make of the DAT boom and what effects that will have?
So I assume you're specifically mentioning other corporations that have other kinds of treasury strategies, right?
Yeah. So, for example, I was at the Blockwork conference in July, and they weren't talking about Bitcoin treasury companies; they're talking about digital asset treasury companies. These are sort of like what you've seen from the Joe Lubin types starting express vehicles for the accumulation of altcoins.
So there's, and again, let's be specific. There's two ways we can classify that, right? We've seen the recent boom with Ethereum treasury companies. So we've got, Bitmine, we've got SharkLink. Ironically enough, the first one in the space was Bit Digital, who was a Bitcoin miner. They were originally one of the ones that were having an Ethereum treasury that they got no credit, they got no credit for because they weren't a pure Bitcoin treasury. But I say that as a bit of a digress. Ethereum treasury companies, and this is coming from me as a Bitcoiner, reluctantly, I have to say that if the stablecoin market grows the way that it's projected to grow, if they are using Ethereum as a primary blockchain for the stablecoin expansion, which in all likelihood it looks like they might and they will.
Could be Solana as well. Yeah.
It could be Solana, but we can come to that. Yep. But let's say that Ethereum catches a bid because of that. The price is going to grow. We can see stability. We can see these treasuries becoming legitimized with Ethereum. That's not me supporting them. That's not me endorsing them. That's just me saying that if that happens, in all likelihood, they may succeed. Now, flip side, am I bullish on Ethereum treasuries? And do I think they have the same properties as a Bitcoin treasury or the same stability or the same fiscal strength as a Bitcoin treasury company? No, I don't. I think they're going to serve a different model. I don't know if we're going to see Ethereum treasury companies, for example, issuing convertible notes. Right? Sorry, not convertible notes, preferred offerings. They've already done convertible notes, but preferred offerings. I don't know how that would work as easily. I don't know if we see hundreds of Ethereum treasury companies the way that we've seen hundreds of Bitcoin treasury companies. But again, I have to caveat that and say, if they're successful, we're going to see copycats. So we can put that in that basket. Now, digital asset treasury companies, I'm completely bearish on. Any company that would have a pool of assets, or let's say you have I know you already have Solana treasury companies, right? But if we now see XRP treasury companies and Cardano treasury companies, I no. I don't think that's viable.
Well, I think the house of cards that I would present here is that, maybe you see these companies rush to market. Some indications that I'm getting from, people who are funding and fueling these things is that they're rushing to market right now. You see a bunch of these more speculative vehicles take this model that introduces these altcoins to these institutions. They see the 80% drawdowns. They see the 70% drawdowns on their coins, and that sort of causes a cascading effect where you end up with reduced confidence in the model that's been created.
Yeah, you could, but and let's take this both from two different angles. Can you really compare an XRP treasury to a Bitcoin treasury? I know people would.
I think there's only one important XRP treasury, and it's owned by the Ripple Corporation.
Well, right. So, or let's take Solana. Bitcoin has a multi-billion-dollar mining industry behind it. We have a proof of work mechanism. We have a global network of nodes. We have going on 16 years of proven network resiliency. Solana, only just now have they started not having massive network outages. I'm sure you remember last cycle where Solana was going down, what, every other week at one point? What is the benefit of having a treasury asset that can be inflated ad infinitum? At least with Ethereum, they can make the claim that it is not as inflationary as these other altcoins. At least with Ethereum, they can make the claim that it can serve as a base layer for a global stablecoin network, right? And global stablecoin adoption. There's at least the claim that can be made there. Whether it becomes what they're claiming remains to be seen. If these companies come out and they fail, could that be seen as an indoctrination of these approaches against crypto? Yes. But I think fundamentally right now, whether we want to accept it or not, Bitcoin has been fully legitimized as a commodity. And as much as I hate to say it, I think because of the ETFs, Ethereum may have been legitimized as at least a technology or as a protocol by the ETFs. They're in a different category than XRP, Solana, Cardano, all these other coins. And even if they get ETFs, and even if they have an institutional bid, I don't know if it's an apples to apples comparison between the two. And I'm just spitballing right now because I haven't really given it much thought.
Yeah, I was expecting maybe a bit more of a bearish take there, but it sounds like you think some of that might stick just for pragmatic reasons.
The toxic Bitcoiner in me wants to give a very different answer, but I'm trying to give a more nuanced answer, a more pragmatic answer. Am I completely bearish on other altcoins being in treasuries? Absolutely. Ethereum, unfortunately, I think is going to be our little brother that we have to deal with. That's just going to be there.
Right.
And we aren't necessarily too fond of him, but he lives in the same house. And in the same house, what I mean is people are going to correlate Ethereum and Bitcoin until Ethereum fails from now until the end of time.
Well, I think they'll also face competition on the stablecoin Rails front, right? I really
They
don't
will.
think that.
They will.
Yeah,
Yeah.
yeah. I don't think the banks are going to let that go lightly, and I really do think that they'll face some continued pressure there. But okay, so we've got that Stairway to Heaven, $1 million. That's the thesis we're putting on here. Do you want to summarize this maybe for the folks? We talked a lot about all the differences and nuances of it, but sounds like you're sticking to it, and this is the thesis.
I am. And the simplest way I can put it across is like this. The current cycle, whether we want to call it a cycle or not, the current point in Bitcoin's history is, in my view, fundamentally different from other points in Bitcoin's history. We have institutional adoption in the form of the ETFs that creates an entirely different investor base. We have corporate adoption, whether we use Strategy, Similar Scientific, MetaPlanet, Smarter Web, all the companies that are adopting Bitcoin in their balance sheets, and they are showing a level of conviction. We have the fact that Bitcoin since the launch of the ETFs has shown extreme resilience. in the form of surviving different, macroeconomic and geopolitical headwinds that at other times would have perhaps caused a more significant market downturn. We have the fact that Bitcoin is showing characteristics of a maturing asset class in the sense that while the volatility is decreasing, the market cap is increasing. And that stability, to me, says that Bitcoin is not only a maturing asset class, but it's a more respected asset class as well. Those coalesce to say that this cycle, to me, is going to have fundamentally different characteristics. Now, in comparison, more succinctly to other cycles, my other thesis is that yes, there is a cyclical nature to Bitcoin. Yes, there has been a correlation with liquidity, but I think we may be confounding stimulus and the effect it could have on assets that at that time were further on the risk curve with purely a liquidity driven event. And we may need to unpack that a little bit more to really differentiate the two. Because if my thesis is correct, in the absence of stimulus, government intervention, Bitcoin has hit all-time highs. We've had restrictive environments with regards to liquidity that are slowly but surely coming off, and the reins are coming off, but we've still seen Bitcoin run up in that environment. When you put all that together, I think we have the possibility for the Stairway to Heaven event where reduced volatility, increased maturity lead to a scenario where the price slowly ticks up because of obviously Bitcoin being a pristine asset, pristine collateral, having a fixed supply, and having its moment, I think, right now with the BlackRock, Fidelity, so on and so forth, ETFs, and with corporate adoption. And if we draw another parallel to an event like the gold ETF launching, the run up in gold was something like 250% over 6 years. That wasn't a immediate 6x. That was a ladder function. Gold just kept ticking up. It had the corrections, but it kept ticking up. That's the most easy parallel that I can make with Bitcoin being digital gold. I think Bitcoin's having its moment right now, and I think we are going to see fundamentally psychodynamics play out.
Adrian Morris, appreciate the time. Where can people find out more about you? Follow the True North folks as you guys are unpacking all that's going on in Bitcoin and macro.
So my handle is right there on the bottom of the screen at Adrian_R_Morris on X. That's my only real social media presence. And True North is also on X as well at MSTR True North on X. We do live streams every Wednesday, save for travel or people just having life events where we can't stream. And I think that is the best way to find us. Oh, we also have a website, mstrtruenorth.com, that you can also find on my profile, a direct link to it, where you can learn about all of us, see previous live streams. We're also working on putting up a newsletter and different articles and information like that as well.
Awesome. Well, thanks for coming on. Interested to see the debate. Follow through in the comments. We'll be taking the debate to London this October. We've got the Digital Asset Summit coming up for Blockworks. I'm sure there'll be a raging debate, as there was at Permissionless, about DATs versus Bitcoin Treasury companies. A reminder, you go to blockworks.co/events. Still tickets on sale there. More to come, and I think we'll be focusing on this debate for a while. The longer we go sideways, I think there'll be more tension on this question. Is the Bitcoin 4-year cycle over? Our guest has given his verdict. Thanks for tuning in. This has been Supply Shock, a Blockworks podcast.